In this video, I'm sharing a highly effective strategy that you can use with the MACD indicator. So, without further delay, let's dive into the details. The Moving Average Convergence Divergence, MACD, is one of the simplest and most popular indicators among traders. It's a trend-following tool that highlights the relationship between two moving averages. First, let's add it to our chart. Head over to the indicator section, type in MACD, and select the top result. Now, before we jump into strategy, let's quickly break down how the MACD works. It has four main components. 1. The MACD line and the signal line. The MACD line reacts faster to price changes, while the signal line is smoother, reacting more slowly. 2. The histogram, which represents the gap between the MACD line and the signal line. If the MACD crosses above the signal line, the histogram turns green. If it crosses below, it turns red. 3. The zero line. This simply represents the center of the indicator. Traders use the MACD to identify momentum by observing crossovers between the MACD line and the signal line. For example, when the MACD crosses above the signal line, it indicates upward momentum. Conversely, a cross below signals downward momentum. The size of the histogram can also show how strong the momentum is. Since the MACD is based on moving averages, why use it instead of just moving averages? Let's compare. Here we have the MACD set to its default settings, 12, 26, and two exponential moving averages with the same settings. Notice that while the moving averages and MACD give similar crossover signals, the MACD often provides earlier entries because we focus on the MACD and signal line crossovers instead of the zero line. This makes the MACD a powerful tool for momentum trading. Now, let's move on to the strategy. One common mistake traders make is using the MACD by itself. Here's why that's problematic. Imagine the overall market is in a downtrend, but the MACD is showing a bullish crossover. The indicator may give you a false signal because it focuses on short-term momentum without considering the long-term trend. To avoid this, I recommend pairing the MACD with a long-term trend indicator, like the 100-period exponential moving average, EMA. This way, you're trading with the overall trend. The strategy is simple. If the price is above the 100 EMA, you look for bullish crossovers on the MACD. If it's below, you only take bearish crossovers. For entries, place a stop loss at the nearest swing, low or high, and aim for a profit target 1.5 times the stop loss. This approach increases your win rate by ensuring you're always trading in the direction of the overall trend. For more advanced traders, you can't just rely on crossover signals, especially in range-bound markets where the MACD may generate false signals. To avoid this, consider combining the MACD with price action. For example, identify key support or resistance levels and use the MACD as a confirmation tool. Let's say the price is approaching a resistance level. You might expect a reversal, but instead of waiting for the MACD to cross down in the same time frame, zoom in 2 time frames lower to catch the move earlier. This technique can give you an edge by providing earlier entries. To recap, we've discussed beginner and advanced MACD strategies that you can start using right away. If you found this helpful, please take a moment to like the video and subscribe to the channel. Thanks for watching, and I'll see you in the next video.